I'm Jeff Aronheim with CrossCountry Mortgage, and welcome to my YouTube channel. Today, we're going to ask the question of, is it a good time to buy in 2024? And it's a reasonable question because there's a lot of fear out there of, are the rates too high? Are home prices going to drop? They're just afraid of losing money, and it's difficult to make decisions. So you're going to want to stay through this whole video because I'm going to share 3 critical pieces of information to help you decide in 2024. And you want to stay for the third one, where I'm going to show you how you can win in this market with your rates 1, 2, and even 3% below market. And before you do anything, please make sure you go below and follow our social media accounts. So for today's key topics, I'm going to talk about 3 key things. Again, rates. I'm going to talk about housing inventory so you know what's really going on. The reason why we're going to do this is there's a lot of information in the news that can be misleading. And I'm going to show you the actual data so you can see what we're seeing and make great informed decisions for yourself. And then in the third part, we're going to share how you can win in this market. So when we start with interest rates, it really comes down to supply and demand. Let's start with inflation, the biggest driver, and what the Fed's looking at. So the Fed looks at 2 key indicators. There's the CPI, the Consumer Price Index, that you can see is at 4%. And then the Personal Consumption Index, which is a smaller basket index that the Fed actually likes to look at. So what the Fed wants is they want the PCE below 2%. But in December, they made a pretty big pivot where they acknowledged, they said, hey, they're going to start changing their position on rates before they even get to the 2%. This is a big change that they had not been broadcasting before then. So we don't know exactly when that's going to happen, but let's take a look at the data and see. So much of the CPI data and PCE data comes in shelter cost. And when we talk about shelter costs, we're effectively talking about rents. And this graph that I'm showing you here is the real-time movement of rents. And you can see they went through a significant increase in appreciation of rents, peaking in about June, maybe May of 2022, and have since come down dramatically since then to about 2.5%. The problem is the Fed doesn't look at current data. They actually look at a 12-month rolling average. So even though we're at 2.5% now, they look at a 12-month rolling average, and you can see that in yellow, where it's almost a 9+ month lag from peak to peak. So even though we're looking at real-time data of about a 2.5% inflationary rate in shelter costs, the Fed is seeing 6.5 to 6.7%. Big difference. What's crazy is shelter cost represents 44% of the CPI. So it is a huge factor on what's going to happen with inflation, and we can tell based on the chart what's going to be happening over the next few months. How do you calculate CPI? Well, they take the last 12 months, the individual readings, and they add them up to come up with the annualized CPI. So what's important to remember is every month you're going to have a new CPI number come on and an old CPI number drop off. In January, the CPI numbers that came out, those are actually the December's data that comes out in January. And you can see last year they were extremely high at almost 0.8%. And that continues last year, 0.74, 0.76. Which is a really high number. Now, what's going to start happening is as these new CPI numbers come out, we anticipate they're going to come in almost half of the numbers that they're replacing. So as you get into what we anticipate for the coming year, you can see much lower numbers that are going to be replacing those higher numbers. So we know inflation is going to be coming down, and we expect to see those numbers to happen very rapidly over the first quarter of this year. Once you get past the first quarter, it's going to be a little tougher to see that movement, but you can expect to see some inflationary changes over this next quarter. So the question is, what are the expectations with the inflation and the Fed cuts? So what I'm showing here is the anticipated PCE numbers that we believe will be coming out. Now, these are assumptions and things can change, but we have the December one that came out in January, and we believe we know what, at a high level, at a very simple, what it's going to look like. As you start to project that out, you can see that that 0.1 is replacing a 0.39 for inflationary number. And that would drop the core PCE year over year to 2.87. And when you start to roll these out over the course of the year, you can see how the core PCE is going to start dropping and hitting that 2% and below sometime in the second quarter. Now, the Fed is probably going to start dropping rates before they get to that 2% based on what they told us. So you can see the Fed can possibly even overshoot and have to get more aggressive later on in the year. When you look at the odds of when that first rate cut's going to happen, here's what's directly from the Fed, what they believe those odds are going to be. So little to no expectation in January, but you get to the March one, and they're showing a fairly significant, almost 70% chance that you're going to start to see rate cuts. 94% chance by May, and then by June, they're just believing it's 100%. And some of that could actually be as much as a 50 basis point or half a point drop. Now, what we also like to look at is what is the Fed like? What is the Fed's mind? What are they thinking? And we look at the Fed dot plot, which is basically, it's an informal survey from the Fed members. They're asking them, okay, over the course of 2024, what kind of basis point drop do you see we're going to have? So when you look at 2024, you can see there's a couple of Fed members that think zero cuts on one end. There's one member that think 150 basis point cut. And then there's the vast majority are looking at that saying, yeah, we think it's going to be a 50 to 100 basis point cut in 2024. So rates are going to be dropping in 2024. And when you move into 2025 and 2026, you can see that they expect them to continue dropping each successive year. So this is really important information to understand as you're thinking about what you're doing. The other thing to consider is knowing what rates are going to do is understanding that as rates continue to drop, more and more buyers are going to enter the space. So the lower the rates get, the more crowded the space gets, the more competitive it's going to be to buy those homes. Now, we also want to look at the Fed balance sheet because that has a huge impact on what happens to mortgage rates as well. Again, this is a supply and demand type scenario where the more the Fed sells treasuries and bonds and floods the market, that can drive rates up. And as they pull them back, that'll drive rates down. So when you look back in 2020 all the way to 2022, they were massively increasing their portfolio and basically being a buyer of these bonds and creating artificial demand. That's what kept rates low. And since then, they capped out around 8.5 trillion in 2022. And then they started selling off their balance sheets, which they need to do. But when they sell that off, they're providing a huge amount of supply to the market, which is a big driver for higher rates. So the question is, they've been selling it off, and how long before they're going to sort of start to taper that off? Because when that happens, you're going to see a significant impact on the rates as well. What's going to do that? Well, when we look at the balance sheet breakdown, we can see from 2014 to 2018, the average percent of total securities on their balance sheet relative to the gross domestic product was 22.4%. Pre-COVID, it was a little lower, and you can see at the peak, we jacked it all the way up to 33%. So definitely not sustainable, and it's appropriate for them to take that balance sheet down. So what do we think is going to happen? As they've been rolling it off, we think it's going to drop to 25%. And as we take it through the rest of the year, you can see that it's slowly going to come down, where I believe in the latter half of the year, third, fourth quarter, you're going to see the Fed start to be able to tapering that off as well. A lot of tailwinds this year on rates coming down based upon inflation numbers and based upon what the Fed's going to do with its balance sheets. Now, why is it important to take those balance sheets down? Well, if they don't do that, they could actually cause a recession. And we don't know if we're going to have one this year or not. The news has been pretty good, but there's always the concern that you have a recession. The thing is, recessions actually lead to lower rates. So if we do move into one, you can see over history, whether it's in the 1970s, the 80s, the 90s, every time you have that recession, you see the rates come down. You will see the same thing as well if that happens here. So with all of that said, what is our forecast for the year? We believe the 30-year fixed rate mortgage, which started in the mid sixes, maybe 6.75, 6.625 in January, is going to slowly head down into the probably the mid fives, something below 6%. And you should know, once you get under 6%, that's going to unlock a lot of move-up buyers who weren't willing to sell their homes with these higher interest rates. With the 10-year Treasury, we started the year at about 4.4%, and we see that coming down to 3%. And that could also impact the spreads that we see between Treasuries and mortgages, which is another driver for what happens with rates. So let's take a look at real estate. And again, it's the same story. It's about supply and demand. What we're showing here is the inventory since 2013 to 2023. And you can see the inventory is really limited. It's tighter than it has been. There's only about 1 million homes that are showing on the market. But the reality is 400,000 of them are under contract. So there's really only 600,000 homes that are available in the market today. On top of that, we have a growing household formation. So the blue line is showing the household formations. Household formation is births. It's new people moving out of their home and buying new homes at this point. And you can see there's a huge disparity between the demand that's out there and the supply, and this is not going to go away anytime soon. So this is another reason why we believe home values are going to continue to stay where they are. We don't see any major drop coming in the near future. Now, one of the big things I hear about is, affordability it's the worst it's ever been. And yes, it is less affordable today, and no one would argue that. We know that. Here's an example that's going to illustrate the point of where the true affordability is looking. So if you go back to 2021 and someone had a $240,000 loan and a rate of 2.875, they would have a payment of about $1,000 a month. To qualify for that kind of loan, they would need a monthly income roughly $4,000 a month. If we look at 2023, we're looking at a higher mortgage amount of 280 and a higher interest rate of 6.625% in January. Rates are higher, home prices are higher. So when you look at that, that's $1,800 a month, or an $800 a month increase, or an 80% increase. And a lot of folks say, well, I'd have to make 80% more in my income to be able to qualify. Well, that's not the case. This is how the numbers work. An $800 increase in your monthly income is a 20% increase in your actual income. So incomes have risen 15% since 2021. So it's not got quite the 20% that we're looking for, but those income increases are continuing. And as rates come down, we're going to see that affordability come back in line. So what's our forecast for the real estate? Well, nationwide, we expect appreciation to be anywhere from 4.5% to 5%. And we see transaction volume going up 15 to 20%. Okay, we've just given you great market information on rates and what the trends are going to do, as well as great market information on home values. So now the question is 2024 the right time to buy for you? And the answer is it may not be. If you are not ready in your heart to be a homeowner, or you don't know where you're going to be living long term, it is not the right time for you, no matter where we are financially, what the market says. So that's the first and foremost thing you need to know. After that, if you do want to be in the market, well, then it's just a matter of looking at the data. And here's what we're seeing is we do think it's a good time. And we feel that because we know right now there's less competition, and it's a great time to get a home with the less competition. And yes, the rates are higher, but over time, we're going to be able to lower those rates. On top of that, you have to keep in mind when the rates drop, your competition is going to go dramatically higher. So for every 1% drop in rates, you're going to see 3 to 5 million more people enter the market, which is much more competition, and that's going to drive prices higher. So between that with the rates, between the market values of home prices being supported, and they may even get pushed up with those appreciation factors, there is a cost to waiting. And I have an example here to just drive that point home, where we're going to compare rent versus home ownership. And I'm going to give you a little hint here. The difference between a renter and a homeowner's equity position, like their wealth, is about a 40-time factor. It's that big. So we'll go through a simple example of a $500,000 purchase price with 10% down, a rate of 6.25. The market's a little above that, but still pretty good rate. And let's just say $8,000 in cost to closing costs, first year's home insurance, everything you needed to buy the home. In the Denver metro area, the average home appreciation over the last 40 years is about 4.62%. Last year was about 6%, so we're actually being conservative. The average long-term rent increase is 5.938% for the Denver metro market. We're also factoring in the cost to sell and the tax implications as well. So if you look at the first year, you could see the rent actually is quite a bit less, but over a matter of a number of years, you can see that the rent is starting to increase more and more. So that first year, your payment but buying a home is $3,500 a month. That's principal and interest, taxes, insurance, as well as maintenance and repairs. Your rent may be $2,577, plus you add a little bit of home insurance, and you're looking at a little over $2,600. So yeah, in the beginning, the rent, it is absolutely more affordable to rent right now. But look what happens over time when you start to look at your principal and interest payment compared to the rent increases. As you go down the bottom left portion of the chart here, you can see these bar charts with homeownership initially expensive, but boy, by the time you get to year 6, you're break even. And then after that, it's becoming more and more expensive to be a renter. Now that's just cash flow. Let's go look at what the actual equity is. So when you buy a home, you are going to get equity over time. And when you look at the net gain of buying a home chart on the right, yeah, if you sell your home in the first couple of years, you'll be at a loss because you have costs to sell your home and realtor fees to pay and various other fees. But by the time you start getting into year 3 and beyond, you're breaking even. And boy, by the time you get to year 6, you're now 6-figure difference in equity that you have in wealth. So you can see over the course of time, it adds really quickly. In 9 years, you have $240,000 in wealth. And as a renter, you have 0. So there is a cost to wait. Now, the final tactic for today I'm going to talk about is the temporary buy down, because this is how you can get 1, 2, and even 3% below market. So what I'm showing here is a $660,000 purchase price with 5% down. You can get a conventional loan with as little as 5 or even 3% down. I'm using a rate of 6.45, and I'm showing you what's called a 2-1 buy down. Now, there's a lot of buy downs out there. There's a 1-0 buy down, a 1-1 buy down, a 2-1 buy down, and a 3-2-1 buy down. The 2-1 buy down basically says if you lock your rate at the 6.45% year 1, your interest rate for your first year is going to be 4.45%. Your second year, it's going to be 5.45%. And then your third year, it's going to be 6.45%. That difference translates in this scenario. Year 1, you're saving $784 a month. And then year 2, you're saving $400 a month. These savings are substantial. And this is a great tactic to be able to get into the market in this high inflationary area. And then we can refinance your rate later when the market comes down. The cost to do that shows about $14,000, but here's the kicker. You get the seller to pay it. So you get the seller to pay it, you get the lower rate, it works for them as well. It works all the way around. Is a great opportunity in this market. So that's kind of your tips. If you want to know more about the temporary buy down, I have a much more detailed YouTube video that you can check out. If you'd like to know more about getting pre-approved to purchase a home and what that process looks like, we have a video for that. And if you'd like to take the pre-approval quiz, go ahead and check out the link below and see what you get. And this is Jeff Aronheim with CrossCountry Mortgage, and make sure you follow us.